let's talk about venture capital. We're always told that when it comes to VC, the biggest returns actually come from the smallest funds. But is that really the whole story? Today, we're going to dig in and figure out if that's a sign of some kind of investing genius or if it's maybe just a trick of the numbers.
You've definitely heard this one before, right? It's a super popular narrative. And to be fair, you see it backed up with data all the time from places like Carta. It really does seem like the best of the best returns are coming from these smaller up-and-coming funds.
But here's the real question. The one we're going to tackle today, is that amazing performance really because of superior skill, some kind of magic touch that these smaller funds have? Or is there something else going on, something a little more mathematical? Okay, so let's start with what I'm calling a trick of the numbers. We're about to see how a pretty simple statistical illusion can make small funds look like they're always winning, when in reality, well, just having so many of them pretty much guarantees a few are going to strike gold by chance.
This right here gets to the absolute heart of the misunderstanding. The story we're told is one of magic, that these small, nimble funds are just, inherently better. But the reality is pure math. High volatility doesn't mean you're more skilled, it just means you're going to get some wild outcomes, both really, really good and really, really bad.
Think about it this way. Let's say you have thousands and thousands of small funds. They're all essentially buying lottery tickets. The range of outcomes is going to be massive. Yeah, a few will hit that spectacular jackpot, but most of them, they're going to end up with nothing. Meanwhile, the larger funds are more like a boring, diversified stock portfolio. The returns are steadier, way less volatile. The problem is, we only ever hear about the jackpot winners.
So, the most important point to get here is this. What looks like a pattern of incredible skill is often just the totally predictable result of a high-risk, high-volume numbers game. It's just math, folks. It's not magic.
Okay, so if fund size is basically a red herring, what actually drives success in venture capital? That's what we're going after now. We're looking for the real performance engine. First, we've got to be crystal clear about what we're even looking for. Real success isn't just about a one-hit wonder. It's about sustained outperformance. That means consistently crushing it, beating the market over and over again across multiple fund cycles. We're talking at least 3 or more vintages. Think of them like generations of a fund. That's the true test of skill, not just getting lucky once.
So how do the best firms actually pull that off? How do they get that consistency? Well, they build a really powerful engine, and it runs on 3 crucial things. Access, which is getting into those amazing deals nobody else even sees. Speed, being able to make a good decision and commit to it fast. And judgment, having the guts to make those contrarian calls that end up paying off big time.
And this right here, this is the main idea of our entire explainer. We have got to start looking beyond fund size. It's not about how big a fund is, it's about how well it actually operates.
So what are these things that matter no matter the size? Well, we're talking about the quality of the team. Are they all on the same page? Are they nailing the timing of their strategy for the market? Do they have a brand that the best founders and talent are dying to work with? It's all about moving fast, having real conviction to go against the crowd, and actually adding tangible value. This stuff is about culture and process, not about how much cash you've raised.
Okay, so this is all great in theory, but how do we actually apply it? This last part is all about how to spot a winner. It's about learning to judge the performance engine itself, instead of just staring at a past track record in the rearview mirror.
And the way you judge that engine is by asking the right questions. So we're going to walk through a few questions right now that are designed specifically to test for those 3 pillars we just talked about: access, speed, and judgment.
Let's kick it off with access. Asking a fund manager, so how do you win non-obvious access? That question cuts right to the heart of their unique advantage. It makes them explain how they find those incredible deals that aren't just showing up on everyone else's radar.
Next up, speed. Look, in a super competitive market, you have to move fast. It's critical. So asking about their time to decision on recent investments, that's a direct, data-driven way to see how decisive they really are. There's no fluff there, it's just facts. And finally, we have judgment. Tell me about a contrarian call you made before the crowd got there. This question really reveals if a manager has the conviction, the guts, to go against the herd and be right. That is where true alpha, those market-beating returns, is really born.
And at the end of the day, you have to test for sustainability. This question forces a manager to really spell out their process and prove that their success isn't just a fluke from one good year. They have to show it's a repeatable system that can deliver results over the long haul.
So the key takeaway from all of this is pretty simple. If you really want to find sustained, high returns in venture capital, you've got to stop obsessing over fund size. You have to start judging the engine.
And that really leaves us with one final thought to chew on. When we look at any kind of success, especially in the world of investing, are we just measuring the final score, or are we taking the time to truly understand the engine that created that outcome in the first place? Something to think about. Thanks so much for joining me.